Hello, today I want to talk about crazy, irrational investor behavior. Now, I have had a couple of other videos on this topic, and you can check out those videos by following these links here. I want to talk about the record weekly global equity inflows. I saw this from a B of A. You can see their chart here. Lots of inflows into equities. We can look at a trend in terms of cash flows in and out of asset classes. Here we can see, the blue bars, lots of money kind of trickling into bond periodically. We do see a big inflow into money market at the end of the year, and then the week of February 3rd, lots out of there. And presumably that money that went out went into the equities the week of February 10th to cause this record inflow. Now, of course, this is global equity. Now, where is this money going? Well, predominantly it's going into the US. So my question is, well, is there a reason why it's going into the United States? And I want to remind you of kind of using the CAPE ratio to predict future returns, right? So maybe the US is attractively valued. The idea here being that the lower the CAPE ratio, the better your subsequent returns, and the higher the CAPE ratio, the worse your subsequent return. So what is the United States CAPE ratio right now? Well, it is currently sitting at 34.77, which is at the extreme. You would expect on average to have zero returns over the next 15 years if you're buying US equities right now. All I can say to that is, I don't know what you're thinking. Now, that's just the CAPE ratio. There are, of course, other valuation metrics. This is a little bit old, but they're only worse now. From this perspective, U.S. equities, again, are extremely unattractive, kind of at all-time highs in terms of how expensive they are. It's almost as if these crazy investors are asking themselves, where can I get the worst investment for my money? And they're piling the money into there. All I can say to that is, yeah, exactly. I'm not sure what you're thinking there. Now, of course, I have some other videos that talk through the CAPE ratio in much greater detail. You can check out those videos if you follow these links here, go into a lot of the theory and whatnot in those videos. Now, also, I've said this money is predominantly going into the US, but it's also predominantly going into the information technology company. So maybe those are the bargains, and I'm just kind of not thinking correctly here. And then the US, even though it's expensive, technology is really where the bargains are. Maybe that's what investors are thinking. So again, to remind you, the chart here, lower CAPE ratios, better future returns, and higher CAPE ratios, worse subsequent returns. Now, information technology, it is currently at, it's at 42.33, which is crazy. It's like worse than it was during the internet bubble. We know how that ended. And even if you dial this back to 32, you're looking at kind of average returns of zero over the next 15 years. So all I can say to that is, of course, yeah, I don't know what's going on here. Now, there is also something B of A in collaboration with Merrill Lynch produces, which is called kind of their global in sentiment indicator. And the basic idea is here is an extreme bear, extreme bullish. Now, the last time we saw it in this extreme bullish case was in 2018. And right now, this is extremely close to extreme bullish right now. On average, when we see it hit the extreme bullish indicator, the subsequent 3-month returns are negative 9%. Just throwing that out there for what it's worth. We haven't quite hit extreme bullish, but we're really close to it given these inflows. I also want to point out the trend for a bubble, stock market bubble on Google Trends. And you can see we're at an all-time high here for people searching for that. So all I can say is, given this information, what do you think? Are we in a bubble? I'm a little bit scared about the valuations here and the money from, retail investors apparently piling into the market. Be careful out there. Thanks so much for listening.